Hi guys, welcome to your third topic. Dividends are distribution of residual earnings of a corporation to its own owners. They are part of the returns earned by shareholders for their investments. First, let's see what companies' payouts look like in the real world. This table here provides payout information for two Australian financial firms, AMP and ANZ. In the third column, dividend amount here, you will see the amount of cash dividend per share. You will find out that the amounts stay stable from year to year for each firm, but they may vary very significantly from firm to firm. Next column, ex-dividend date, is the date on or after which the stock will trade without dividends. Since dividends is sourced from earnings, distributing them often reduces the stock price. The column percentage franked specifies the proportion of franked dividend within the imputation tax system. I will give you examples soon. You can also find there are two types of dividends. One is called interim and the other is final. There are other forms of dividends in addition to cash dividends as well. For example, from the last column, you will find DRP, which stands for Dividend Reinvestment Plan, and BSP here, you will see it stands for Bonus Share Plans. You can explore more about dividends on the Australian Stock Exchange website. Now we turn to dividend imputation system, in which companies essentially pay tax on behalf of shareholders so that profits will not be taxed twice, one at corporate tax and one at personal tax. To illustrate, please see the following example. A company paid a franked dividend for $200 and it is 100% franked. And also assume that the personal tax rate is 47% and the corporation tax rate is 36%. What is the net dividend an investor will receive? Now to calculate this, first we need to calculate the gross dividend, the dividend before corporate tax. So I will write as this equals to franked dividend before corporation tax. So this will equal to 200 times 1 minus 0.36. And this gives us $312.5. And next, we know the gross dividend and we know the franked dividend. Franking credit can be calculated as the gross dividend minus the franked dividend equals to gross minus the franked dividend, and it gives us $112.5. So now, I actually used an alternative way to calculate the franking credit. You can also follow the way that is described in the prescribed textbook. That is, franking credit also equals to the franked dividend times the corporation tax rate divided by 1 minus the corporation tax rate. Next, we need to calculate the personal income tax on gross dividend. Income tax equals to the personal income rate times the gross dividend. And this gives us 0.47 times $312.5. And the result is $146.88. So to calculate the next tax, it equals to the personal income tax minus the franking credit, because the franking credit is actually what you will get from the company. And this gives us $146.88 minus $112.5, which is 34.38. This is the tax that you need to pay after taking consideration of the franking credit. And finally, your net dividend would be the franked dividend you received from the company minus the net tax you need to pay, which equals to 200 minus $34.38 equals $165.62. Another form of dividend takes the form of share buyback, or you can call it share repurchase. Companies pay cash to repurchase shares from its shareholders, through which shareholders can realize both dividends and capital gains. In a perfect market, repurchasing shares is essentially the same as paying cash dividends. See the example provided in the lecture notes. In reality, there are a number of reasons why firms choose to repurchase shares, such as financial flexibility, that is, no formal commitment as dividends, or selectively affecting shareholders. Tax considerations. Please read the news in the provided link about Telstra's recent share buyback for this reason. And impact on stock price. As we know that dividends announcement usually comes with share drops. So, dividend policy refers to the explicit or implicit decision of the board of directors regarding the amount of residual earnings, either past or present, that should be distributed to shareholders of the corporation. There are two types of policies. First, constant payout policy, and second, progressive dividend policy. You need to know their definitions and differences. Recall that dividends can be very different from the firm to firm from the table. So, should firms pay dividend or pay more dividend value more or less? Dividend policy irrelevance theory, proposed by Modigliani and Miller, answers no to this question. It is noteworthy that the theory is based on a battery of unrealistic assumptions. You need to know what are they. And in the lecture notes, I have provided both mathematical derivations and an example to illustrate the irrelevance theory in a perfect market. How can we apply the theory if its assumptions are unrealistic? Actually, the value of this theory is that it offers a great framework to understand the factors that were excluded from its analysis. Thus, by releasing the unrealistic assumptions, we are able to find out such factors' impact on firm value. So first, taxation affects shareholder wealth by affecting the after-tax returns. And if dividends and capital gains are taxed differently, investors may be attracted to payments incur lower tax, that is, tax-induced clientele. You need to consider tax effects on the classical and imputation tax system respectively. Second, if information asymmetry exists, and the dividends contain information or can signal certain information, then dividend policy may affect firm value. Third, dividend policy may also matter because dividends may reduce free cash flow problems raised by Jason 1986. Thus creating value for firms. Lastly, there are other factors such as transaction costs, which is incurred if investors need to realize their capital gains, and flotation costs due to the need to issue shares to make investments, as well as behavioral issues.